Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. It's been a couple of weeks since you heard from me. Thanks to my teammates for filling in as I visited clients around Asia from my temporary base here in Singapore. One of the topics that I've been discussing with clients lately is that of the potential for slowing growth to start to emerge as an increasingly dominant theme, and perhaps not the dominant theme, but an increasingly topic of conversation, as the idea, the fact we have high inflation and central banks responding to that being, well, in a phrase, starting to get priced in the markets, or at least, fairly well known. And if this does indeed become the case, where investors start worrying about the slowing down of economies, whether due to the increased tax that inflation is on consumers, or worries about the slowdown that's spurred from aggressive central banks, it could put a stop to the recent rises in bond yields led by the US and in turn impact the fairly steady increase in the value of the US dollar that's come along with it. To be clear, central banks are going to have a hard time turning dovish or stopping hikes due to still high inflation. But if growth slows, the ultimate terminal rates that the markets believe these central banks will get to may not be as high as investors fear now. And yes, still high inflation and slowing growth is a stagflationary theme, as we've been discussing. But unfortunately, I do think that is what we're both in and likely to remain in for some time. And nowhere is this more the focus in Europe, where the ECB, at least I think, is in an impossible situation. They face high inflation pressures like most of the rest of the world, but also have a war in their doorstep. And the impact of supply chain disruptions and the impact of higher energy prices on their economies is already strong. So with that said, I want to bring in Giovanni Zanni, our chief European economist. Gio, we're talking before the ECB meeting, and then the recording will be released after it. So even so, I don't expect too much new. And I think we could talk a bit more about the long-term economic situation in Europe. Given what I just discussed, how does the ECB approach this situation via policy? You got to tighten, they're potentially, or the market's expecting, I should say, them to be tightening into growth risks where those risks are pronounced, but the inflation shock is really an external matter. I mean, that makes that all a pretty difficult decision, right?
Yeah, difficult. Well, yeah, I mean, it's mission impossible, and that's why the council is so divided right now. So we have this kind of profound uncertainty on so many levels. And yes, you were mentioning inflation. It's also in Europe very high, but almost all of it is coming from energy. So of the 7.5% that we had last month, 2/3 were on energy directly, and then some of that was also in core and directly linked to energy. So will high prices persist? Will we have the second round effects on wages, inflation expectations adjusting? Well, that's a key question, but we don't have the answer right now. And meanwhile, it's pretty clear that activity is decelerating. Of course, in Europe, we are closer to all these events in Ukraine, and the confidence side of the story is clearly showing up. I mean, consumer confidence dropped very significantly. And yeah, at the same time, we have some recovery because of the Omicron exit. But, again, who knows? And certainly not the ECB right now. So for me, that it's really a good reason not to change the guidance at this week's meeting. They said they will continue to taper in Q2, yes, and that they will reassess for Q3. Then clearly, a central call has to be one where the normalization continues and rates eventually go up because of where they are and because of what's happening also globally. But right now, I guess the patience has also to be part of the equation. The last point I would say that is also relevant in this kind of uncertainty situation, difficulty for monetary policy to act, is fiscal policy. So the ECB is also there to watch what's happening on the other side of the policy spectrum. And we had some measures that are going in the right direction, in my view. For example, increasing purchasing power, and also reducing inflation through indirect taxes on energy more specifically. So things are evolving there too. I think that June will be a first moment to assess all these aspects: the fiscal policy impact, the indicators from activity and the Ukraine situation as well.
You use the word patience. I just think they're trying to buy time to some degree. But so as we head towards, some of those assessments that might come up down the road, or as you say, at June, what should we be watching for as a key indicator? You mentioned wages. I know that at least in other central banks have pointed out, wages as potentially being an indicator about whether we see this pass through or inflation becoming more sticky. Is there any indicator, that included or others, or speakers going forward, that give us the best clue on which direction the ECB will tack, whether it is towards, move creeping closer to raising rates or trying to buy more time?
Yeah, so in terms of speakers, as I said, the council is pretty divided right now. So it's difficult to just have a clear view. But let's say that there were two pillars of the views: the moderate Hawke, Schnabel, and the moderate Dove, Lane. And so I think and these two have evolved towards like a more common view, which is a bit more hawkish than it was before. But any change of view from these two in particular, in one way or the other, will be quite relevant. And of course, Lagarde, who has been more hawkish in all the meetings, the recent ECB meetings, more hawkish than expected, but then backtracking a bit or adjusting, fine-tuning towards a more dovish stance in the subsequent intervention. And actually, her latest ones were a bit more dovish. Can we expect the ECB to be dovish on Thursday? No, because even if it's current inflation, etc., but 7.58% is 4 times the target. So and it's a bank that has only that as a benchmark, as a target, so that they cannot say, well, that's fine. So but yeah, so I would say these are the 3 key speakers. In terms of data, you mentioned wages, and yes, wages, but reality is that everything we've seen so far is not telling you that wages are growing too much. Actually, the contrary. And given the kind of consumption tax you were mentioning, that's an issue as well. So wages for now are definitely too low. A 3+% will be consistent with 2% inflation. We are something that is below 2 right now. So I'm sure it will change, but it's not happening. And the first indication that could have brought that are not going that direction. And the other thing is inflation expectations. And yes, they went up, but they are 2.4%, which is more than expected. A lot of this is risk premia, but it's still not out of control, definitely.
Yeah, and on the wage front, you just reminded me, we have nominal wages might be going up in various parts of the world, but real wages are suffering because of as you say, the inflation that we're seeing. So just more generally, one more. How worried about growth, and have you revised up your long-run inflation forecasts? In other words, do you think that structurally, a year or 2 years down the road, let's just say, or I'll make it more vague, if when we get through some of this period of, intense supply shocks and hopefully, the conflict on the border of Europe here, but do you think we're heading to a structurally more inflationary European economy in the long term?
Okay, so on the growth side, I'm definitely more worried short term, and of course, Ukraine, China, even the French elections, by the way, could be a shock there. But I won't go into that this time. But in the medium term, I think that there are good reason to expect growth in the euro area to be on average stronger than it was pre-pandemic, just because they started to use fiscal policy at the European level more proactively, and that I think is a game changer. I think that's still the case, still important, and maybe even more so after this latest shock in Ukraine. In terms of inflation, well, in part because of what I just said about growth, yes, I expect inflation to be higher. And again, that was already the story that we described after the pandemic. And again, this is again reinforced. Then if you tell me, do you think that we'll get hyperinflation in Europe? No, I don't think so. So my view is more that we can get the 2% or even slightly higher in this phase of transition, to adjust with all these supply shocks, etc. And then the final result will be an inflation that it's more 2% something than 1% something that we had before. But if you ask me if I expect 3% plus, no.
Thanks, Gio. That was really great. Next week, we get the final European CPIs and PMIs, UK retail sales, and the speaking highlight is going to be Powell and Lagarde speaking on IMF panel on the global economy on Thursday. We also get Bank of England's Bailey speaking on Thursday. And sticking with our European theme, Gio did mention this. We'll get into that a little bit more perhaps next week. We're going to be watching developments regarding the French elections, including a debate on the 20th as we head into the second round vote on the 24th. So with that, let's call it a week, and good luck, everyone. Have a great week. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.